So during this session, each of our 4 analysts will have 7 minutes on stage to present on a key banking topic or fintech trend that they think is kind of most worthy of communicating to you all, our audience today. So unlike our 7-minute demos yesterday, slides are allowed for these folks, so you will be seeing some great graphs and charts and things like that, and hearing some very insightful things. Similar to the demos yesterday, however, there will be a gong at the end of 7 minutes, so beware, 7 minutes is strict. So with that, I'll introduce very quickly, and then we'll start with the first one. We have Allison Clark, Principal Analyst at Forrester, Jegher, SVP Banking Head of Strategy at Javelin, Dan Lattimore, Senior VP of Banking at Celent, and Thad Peterson, Senior Analyst at Aite Group. So Allison, how about you get us started today?
Perfect. Thanks, Julie. Thank you. Well, in order to understand what's hot in fintech, the first thing we need to do is we need to look at your customers, because that's what's going to help us identify where the real opportunities lie. So about 10 years ago, Forrester developed its Customer Experience Index score, which looks at and measures how successfully a company creates experiences that create and sustain loyalty. Now, we look and survey customers of around 800 global firms across 18 different industries, including financial services. And we look at around 50 different drivers that are unique to each industry. And the index tells us how well a customer interaction drives retention, enrichment, and advocacy. Now, why are these interactions important? They're important because firms that drive great customer experiences and lead in this area are growing revenue at a much faster rate than their peers. My apologies, we have different slides up today. This is not my actual live slides. So what we see in our results is actual lack of differentiation is the current state. So what we see in the results is that while we have a few people exceeding and kind of surging ahead of the pack, what we do have is some laggards that are bringing up the rear and behind. But generally, most financial services firms, they group right in the middle and they cluster, which tells us that customers don't think that the experiences are differentiated at all. And when we look deeper into where financial services firms fall down and what they do wrong and where the real opportunity lies and how you can grow revenue, it's about focusing on emotion and what matters most to your customers. In fact, emotion has a bigger impact on brand loyalty than effectiveness or ease. Now, what do I mean by emotion? Well, quite simply, how customers feel about their interactions with you. Now, sadly, we find that financial services firms do very poorly on emotion compared to ease and effectiveness. So, be it banks, investment firms, insurers, and even credit card issuers, you all do very well at delivering experiences that are easy and effective, and your investments are paying off in that area. But you fall behind in terms of emotion. And to put these numbers in context, the leaders that are driving great experiences and growing revenue, those emotional experiences, they score around 70% in our Customer Experience Index. What are these emotions? What are the emotions that are really important in driving revenue growth? Well, it's not making them happy. Our data tells us that it's about making your customers feel appreciated, feeling respected, feeling valued, and feeling confident, and trying to make sure that they're not annoyed, disappointed, or frustrated. Many firms, many financial services firms, customers don't feel respected and they don't feel valued, and that affects your bottom line. So what's the biggest opportunity that you have? The biggest opportunity is technology that can help you drive positive emotional connections with your customers. And this comes in 2 forms. The first is technology that can help you drive positive emotional experiences through digital touchpoints. And this is about delivering engaging and personalized experiences through those touchpoints. Some examples of this: customer outcome orchestration. What do I mean by that? What I mean, this is about understanding customers' intent and using it to serve up digital content, specific functionality, and even easy kind of digital experiences across different devices that are purely focused on driving customer outcome, not pushing products. Personalised financial coaching is another great way to drive a positive emotional connection with your customers. And we see many firms like BBVA in Spain using artificial intelligence to drive personal financial coaching. And they do this by delivering personalised recommendations to their customers based on their financial health score. Now, this tool, B-Economy, which was launched in 2017, within the first 3 weeks, they had 500,000 customers sign up for the service, which just goes to show that customers are really craving this information and insight from financial services firms. We've also seen examples like Nomi, RBC, that helps people save and reduces the cognitive load and stress with saving because it automatically does it for you. And integration of human help and collaborating with other people through digital touchpoints also helps drive an emotional, positive connection and impact with your customers. So tools like video and chat allow customers, like those of ABN AMRO in the Netherlands, to connect with a human when and where they need it most. And we know that human connections really do help drive positive emotional experiences. But as well as looking at technology to focus on driving positive emotion through digital touchpoints, it's really important to use technology and think about what technologies can help you drive emotion through human touchpoints. So, for example, making sure your employees have a 360-degree view of the customer with real-time insights. That's going to enable them to serve up better, more personalised and engaging and positive emotional experiences. But you've got to look beyond the products and relationships they have with you to look at their behaviours, the sentiment, the context, their attitudes, and the content they're interacting with. And you can take this further by focusing on the next best interaction. Now notice, I don't say next best offer. If you're focusing on the next best offer, that's not necessarily going to drive an emotional impact, a positive emotional impact. What you need to focus on is the next best interaction with your customers or next best conversation. And we're seeing firms like Morgan Stanley, their next best action system employs machine learning to help their advisors really understand what they should be talking about with their customers next. And lastly, whisper agents. These are a great tool to help contact center agents deliver more empathetic experiences. So using speech analytics, AI, and predictive analytics, these tools can help deliver curated and deep insights to contact center agents. And in turn, that allows them to deliver more personalized and empathetic and more positively engaging customer experiences to customers. But at the end of the day, underpinning all of these ways to drive emotion and positive emotion with your customers, there are many different technologies. You need to combine them together to deliver the best, from insight platforms to intelligent agents to cloud platforms. And at the end of the day, if you want to know what the hottest fintech is and the technology you should be investing in to really drive growth and value in your business, then you need to focus on the technologies that help you drive positive emotional experiences and focus on what matters most to your customers. Thank you.
Thank you, Allison. Now we have Jacob Jegher, SVP Banking Head of Strategy at Javelin. Take it away.
All right. Good morning, everyone. Last year, I stood on this very stage and talked to you about the opportunity of banking the boomers. Well, today we're going to look at the opposite end of the market and talk a little bit about kids and Generation Z, essentially anyone born after 1995. So this is not a stock image. These are actually my 3 children up on the screen, and I'm going to start the presentation today with a bit of a personal story. A couple of years ago, I took my 2 older daughters on a very interesting trip, a little field trip to open their first bank account. And the experience was absolutely abysmal. Essentially, the banker arrived late, and then my kids watched for an hour as I filled out paperwork and signed on their behalf. It was a missed opportunity, and it essentially left me as a parent underwhelmed. For my kids, they were completely disinterested in the banking experience and remain so today, even though they are still quite young. But essentially, these are still 2 new customers for the FI, and it's a lost opportunity. My kids are but the tip of the Gen Z iceberg. This is a much bigger market, and it's an emerging one. But what's different about them? I'm going to bring a few different points. We have a lot more in a recent report on this. But essentially, these are just to illustrate who these are outside of financial services. So their worldview is shaped by all kinds of things, including the 2016 election, student-led protests, topics like economic inequality, lots of stuff around data privacy and security, for example, scandals we've seen around Facebook and Cambridge Analytica. And they also do things like consume media very differently. So this is the Instagram and YouTube generation, right? They don't watch TV like we used to watch TV. Their influencers are the folks who are the stars on YouTube. And more importantly, even as they enter the workforce, because some of them are already in the workforce, their nature of work and perception of debt is also changing. And we have some data on that from some of our studies. But essentially, they're likely to skirt traditional educational models, or some of them are, and participate in things like the gig economy, or seek revenue from multiple sources. Some rapid-fire stats: they unsurprisingly live on the smartphone. Device ownership: 95% of Gen Z customers that we surveyed own a smartphone. And this extends into their banking activities as well. So 42% of them say, we prefer to bank using mobile banking with our smartphone, and that's actually higher than the coveted millennials market that we've heard so much about, which sits at 32%. Some defining financial characteristics, and these all come out of survey as well. So random but interesting tidbits. 50% of them who are already eligible or have started to establish credit check their credit at least quarterly. They're very interested in obtaining financial insights and advice from their financial institution, and they would like to understand things like which debts to pay off first or how to spend more efficiently. There's also some interesting trust issues going on with Generation Z, and they're quite wary of tech companies, big tech companies like Apple, Amazon, Google, Facebook, etc. But they are, however, quite trusting of large financial institutions as well as community banks and credit unions. Now, why do I tell you all this? I tell you all this because it's going to be key in terms of how to build a relationship. Because guess what? These folks switch banks in their 20s. Quick look at this chart shows that switching peaks at the age of about 30, at 29% who say they switched banks in the last 2 years. And where do they go? They tend to go to the largest of FIs. If you take a look at the consumer market or even Gen Y, the millennials, 70% of them today indicate that they bank with the top 7 bank, which essentially means that financial institutions have a lot of work to do in order to retain these customers if you're not part of the top 7. How do they pick their bank? Well, not shockingly, just like me and my children, they bank where their family banks. They have accounts that are likely set up for them by their parents. But what keeps them at the bank is a whole other story. Essentially, this is a digital story and, interesting, a branch story, right? So convenient location of branches at 55%, who would have thought, the youngest generation? But of course, digital, online, and mobile capabilities. So if you're a financial institution and you want to focus on retaining these customers, or if you're one who says, this is an opportunity for me to acquire them, what should you do? And I'm going to present to you 4 key takeaways that are going to be imperative as you think about banking this market, and essentially as they mature and grow older, and of course obtain assets and enter the workforce. The first, you have to win over folks like me. And by like me, I don't mean as an analyst, I mean by me as a parent, right? So you got to win over the parents. Make that experience special and fun when the kid goes to the bank, right? So I wrote a blog on this a few years ago when this experience happened because I couldn't believe it. But you got to win over folks like me, get us involved in the process, have us talk to our kids about banking and savings, and get us into it. Second, regardless of what stage and time the kids are at, you have to make banking fun and relevant. And there's so much that can be done over here, right? So if we're talking about little kids, maybe that account opening process, something should have been integrated into it. If we're talking as they're growing up, maybe we should be doing things like encouraging savings through an app, because all of our kids are extremely digital. And as they become teens and young adults, there's a lot more that can be done for them as well as they develop their own financial needs, need to obtain credit, move away, go to college, etc. Right? There's an opportunity to build a relationship with essentially what is the next generation of banking consumers. And how should you do that? Well, I mentioned earlier that they're very interested in obtaining advice and insights from their financial institution. Essentially, the ability to avoid missteps is something that is huge. And if you're looking for things like tools that can be directed specifically at this market, that'll get them involved in it, help them save, help them become more financially savvy and better consumers in the financial world would be a wonderful thing. Finally, as they enter the marketplace, there's an interesting opportunity to offer them solutions that are targeted at freelancers and entrepreneurs. And this is a separate topic in itself, but it's worthy of mention given some of the trends that we've noted about Gen Z. And we have a recent report that covers this topic as well. But solutions to cover freelancers and entrepreneurs, whether it's payments acceptance or helping them form a corporation or do their taxes or what have you, there are a lot of interesting tools that can be provided here. I'd like to thank you very much for your time and attention. If you have any questions about my presentation, please feel free to reach out. Thank you.
Thanks, Jacob. It's great to hear kind of about a different generation than just millennials, which I feel that is kind of beating a dead horse at this point. So thanks for that refreshing perspective. All right, I'm going to turn the stage over to Dan Lattimore, Senior VP of Banking at Celent.
Great. Well, thanks very much, Julie, and great to be here at Finovate. I'd like to talk to you about customer experience, and I prepared some of this a couple of weeks ago. Turns out, yay me, to be very prescient, because as we looked at the 2 days of presentations and demos, fully 1/3 of the demos up here talked about customer experience. It is wildly important. But let me shift gears a little bit. I think it's sometimes easy to get caught up in this and say, oh my goodness, we are so far behind, we are never going to win. There is a book called Factfulness. Anyone read it yet? A couple of hands. I highly recommend it. Hans Rosling, who's a Swedish public health researcher and unfortunately just passed away, said we need to learn to control our drama intake. Uncontrolled, our appetite for the dramatic goes too far, prevents us from seeing the world as it is, and leads us terribly astray. So what does this have to do with fintech? Well, does the rise of fintech spell the demise of banks? Retail bank branches doomed and banks don't know it. 33% of millennials say they won't need a bank in 5 years, said Goldman Sachs in 2015. I think the millennials now have 2 years left, I guess, before they don't need banks, but they're getting older, they do need financial services, and banks are their first place to go to. And just in August, on LinkedIn, someone posted the slow death of retail banking companies. And these make great headlines. But what Rosling also says is that here are a couple of headlines that aren't going to get past a newspaper editor because they're unlikely to get past our own filters, which is his nice way of saying they're boring. Malaria continues to gradually decline, or meteorologists predict that yesterday there would be mild weather in London today. That's not really very exciting. It doesn't get click-throughs. So what are the banking analogs? Well, banks continue to make progress in improving the customer experience with hiccups along the way. I think that's pretty true, but it's not going to get anyone to click through. Or fintechs innovate to push boundaries, but many have a hard time executing at scale. Again, you're not going to get a lot of people coming to your website or a lot of Google hits on that. So I'd suggest we all take a breath and think about the reality. We have done great things, but also get beyond this notion that fintechs are doing all the great stuff and banks are just slow and clumsy and not able to do anything right. The reality is a lot more subtle, and subtlety doesn't come through in tweets or in headlines. So what we did was look at some mobile banking opening operations for a bunch of different institutions. And your initial thought might be, well, the fintechs are going to do great and the banks are going to do terribly. Not really the case. We looked at the App Store rating and then our own assessment of the experience. And in the upper right, which is where you always want to be, you see the big four incumbent US banks, along with Varo and Fin by Chase and Chime. But GoBank and Simple didn't do so well. And then Memory Bank is a digital-only bank from a little Midwestern community institution. They just didn't have the resources to actually make the app that good, frankly. But let me show you some of the screenshots that we encountered as we went along this account opening process. Wells actually used the camera to pre-fill your information. And of course, at Finovate, we've seen that over the last couple of years, but it doesn't always work. I went through one where I just couldn't get it to take my driver's license. I had to do it manually. It was infuriating. Wells got this right. Chime, who scored very well, still didn't use the camera. You had to fill in your information manually. So even these great fintechs who score very highly still have opportunities to improve. Citi did a great thing earlier this year. They took their app and they made it available to anyone. You didn't have to be a Citi customer. You could use it on your own to aggregate your view of your own finances. And their hope, of course, is that you will like this and then you will become a Citi customer. I think it's a brilliant move. GoBank, which, mobile-only bank, said they'd get us our debit card in 7 days. It took 14 to arrive. Execution matters, and that leaves a terrible taste in people's mouth. And Fin, finally, they let you put in your zip code, and then it pre-fills your state and your city. Brilliant, simple, and long overdue, certainly on a mobile. So let me shift gears for a minute. Get it? Shift gears. So my car recently died, and I'm a cheap Yankee. We drive our cars into the ground. This was a 2006 with 187,000 miles on it. And our trusted mechanic said that it was not worth fixing it. He ended up giving us $500 for it. So I went to explore with various banks what I could do to have them assist me on my car buying process. A bank who has great headlines, a lot of press. I have $100 in them as a test account. I went in, this is what the statement looked like here in 2018. It looks like it's from 1985. They have figured out the front end is where to spend their money, not here on their statements. And that's fine, but everything doesn't permeate throughout the stack. A lot of banks are getting headlines for this. USAA, US Bank, Bank of America, Chase, all are offering to help on the car buying journey, but that's the headline. The reality is that USAA wouldn't give me terms until I consented to have a used car salesman call me. No, thank you. Chase just sent me to TrueCar and then kind of stepped out. I think I might have saved a few basis points if I financed through them, but their rate wasn't that good. B of A actually helped me a little bit more, but their rate wasn't as good either. And they're not CarMax. I mean, CarMax would say, here's your price, you get the car and you get what you want, but I don't really trust them. What I really want is someone who will get me a fair price, I trust that it's a fair price even if I don't know it, and put a car literally in my driveway. And that hasn't happened yet. There's a long way to go. It's a great opportunity, I think, for folks. We ended up going with the mechanic who went to auction for us and got the car we wanted, and I suspect he made a few $100, but I trust him. So let me finish with a final Rosling quote. Critical thinking is always difficult, but it's almost impossible when we're scared. When things are getting better, we often don't hear about them. This gives us a systematically too negative impression of the world around us, which is very stressful. So relax. Thanks.
Thank you, Dan. I think we've all had that kind of facepalm moment when we received that 1985 era form from our bank in 2018. It's frustrating. So I'll hand the stage over now to Thad Peterson, Senior Analyst at Aite Group.
Thank you so much, and good morning, everybody. I'm a payments geek. Any payments geeks in the room? All right. I study mobile wallets and things like that, and I was doing a report on mobile wallets and trying to understand where Apple Pay and stuff like that was going because that's what people pay me to do. And so I started to look at this thing, and I found some interesting information that I wanted to share with you. The good news is that mobile and online commerce are continuing to grow. Increasingly, the share of U.S. retail is growing rather rapidly on e-commerce. The numbers are generally around 11 or 12%, but in reality, if you take out groceries and auto dealers and stuff like that, and you just look at traditional retail, it's much closer to 20% in terms of online commerce. Internationally, it's growing even faster. Excuse me. Cross-border volume increasingly is significant across the world. It's already 15% of digital commerce in the US or North America, but that's still a minuscule component of overall commerce. It's like 1%. But the growth is accelerating. Just about every merchant should be looking to sell stuff overseas because that's where their customers are starting to come from. That's good news. Transaction volume is growing globally, which is a pretty big deal and pretty cool. And if you take a look at where the growth is, in the green circle, you'll see that it's basically in the developing world. And they're growing at a CAGR of around 19%. The mature world is growing at around 5%. And I've been in payments for a while. I've always assumed that the way the world was going to work was that the credit card companies would grow, the networks would grow as people became more affluent. When people became more affluent, the networks would come into the market. People would start getting credit cards and debit cards, and Visa and MasterCard would continue to rule the world. And that's what I thought was going to happen. And then suddenly it wasn't happening because other payment types are starting to show up. And they're showing up in force, not just a little bit. So if you look at PayPal is a dominant factor. PayPal is in a position to be an acceptance brand. They're clearly going into the physical world with POS. They clearly want to be a competitor to Visa and MasterCard. That's not a question. The other alternatives are pretty dominant as well. So it's not a Visa MasterCard world. Mobile money is exploding globally. Mobile money is the stuff that you see in Africa and Southeast Asia that is basically phone-to-phone payments. It doesn't use a smartphone. It doesn't have to. It can. But it can be done on a feature phone with text messaging. It basically came in because there's a giant vacuum in terms of moving money around. The first example, of course, is M-Pesa in Kenya, but those have grown dramatically across the world. And if you look at the rates of growth in sub-Saharan Africa and South Asia, you can see that it literally is exploding. Faster payments are growing as well. There are about 39 different schemes in different countries now for faster payments. All of them are very, very good at moving money quickly from one individual to another. Great example in Australia is a thing called New Payment Product, clever name, otherwise known as NPP, that is really taking off. And one of the things that's interesting with that is that you don't need to give a customer or an individual an account number. You can register this with an email address. You can register this with a phone number. You can register with an account number. It doesn't really matter. None of these, by the way, are driven by the payment networks. They're all standalone, closed-loop systems. And then there's China. China is completely card-free, pretty much. It's all about WeChat Pay and Alipay. They started about 10 years ago and have taken off. There are now about 1.7 billion active customers in China on these two payment schemes. If you go to China, that's the way people do things. They don't carry cash, they don't carry cards. Most people don't have cards, and there's huge payment volume happening out there. Again, nothing to do with the networks. So if you take all of these things, you take faster payments, you take mobile money, you take the stuff going on in China, put all those things together, and you take a look at where non-card payments are going, or non-network payments, you see that the growth rate of non-network payments outpaces growth rate of traditional network payments in about 2022, 23, somewhere in there. This is kind of a scary chart if you're a Visa person, because even though these aren't specifically payment related, the probability that those transactions are Visa or MasterCard is very, very low. It's going to be a bunch of different payment systems. It's going to be non-network based. It's going to be very, very chaotic. It's going to be a real mess. So what does this mean? You have to have a different vision for the way payments are going to go. We've all thought about Visa and MasterCard, American Express and Discover as kind of like the entities that were going to own the world forever. They're going to own a big chunk of the world, but they're not going to own it forever. Single-use wallets like WeChat Pay are going to overwhelm the open platforms because they work better. WeChat Pay is part of WeChat, which is an app that functions essentially as the internet for most Chinese people. Wallets and mobile payments will need to be adaptable to different platforms, tender types, and acceptance protocols. They have to be able to accept everything. If you're in Holland and you don't offer Ideal on your mobile wallet, it's not going to be used. Every player in the ecosystem needs to adapt to a new vision, disaggregated, regional, and continually chaotic. That's where we're going. What you do about it? If you're in this space, you have to have a global, agnostic vision of payments, regardless of current geography, platform, or tender type. Globalization is going to affect everybody. It's not just the people who are on the edges. It's not just the people who cater to Chinese. People are buying stuff across borders all the time now, and the borders are increasingly transparent. Assume that multiple payment networks will coexist in nearly every market at scale. So in our world here, we have something called real-time payments showing up. We have Zelle showing up. We have push-to-debit showing up from the networks. There's a whole bunch of stuff going on, and that's the same as it is in every other part of the world. Lastly, friction is failure. Figure out ways to simplify and minimize the complexity of managing multiple payment alternatives, because they're going to be there. And one of the things that everybody's talked about this morning is the challenge of friction. So with that, I will leave you with one major idea. Instead of risking anything new, let's play it safe by continuing our slow decline to obsolescence. Thank you.
Thank you. Great stuff, Thad. Thank you. I love that last point. Friction is failure. I think that applies, all across FinTech. With that, let's give our analysts one last round of applause. Great job, guys.